Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. So today we are going to discuss a very important master action that has been released by the Reserve Bank of India. We are going to discuss a very important article of or the notification of the Reserve Bank of India. Okay, so the RBI has released this master action on its website recently. Very recently, RBI has released this master action on its website, and this is a very important master action, as here we will discuss about the credit derivatives, that is a new component that the RBI has released, especially a new product, that is the TRS that the RBI has introduced. So before also there used to be the credit derivatives, and the most popular credit derivative used to be the credit default swap. But now the RBI has announced the TRS also. So we will discuss that what is the credit default swap, what is this TRS, what are the facts that you have to remember from the phase 1 perspective as well as the phase 2 perspective for the 2027 examination, as well as for the phase 2 perspective for the 2026 examination. Okay, so this particular article, it is very important for your 2026 phase 2 examination. This article is also important for your 2027 because the credit derivatives, this is a new term, or this is a comparatively new term. The TRS is a new product that we have to discuss, and this will help you to build your knowledge going further on. Okay, so if you are going to give the phase 2 of the RBI Grade B 2026 examination, this article will be very, very important. The facts are going to be important, as well as for the students that are preparing for 2027, this article is going to be important because it will provide you the broader understanding of many of the terms. Okay, so let's get started. First of all, give me a thumbs up if I am clearly audible and visible. The facts are going to be important. I hope everything is fine. So let's get started with today's session. Okay, and the PDF of the session you will get in the Telegram channel of EduTap. So in the Telegram channel of EduTap, within 24 hours you will get the PDF of this session. Okay, you will get this PDF. So now we are starting with the master action, that is the master action Reserve Bank of India Credit Derivatives Directions 2026. So in the debt market, so as you know that the capital market is under the Securities and Exchange Board of India. Okay, the capital market is under the SEBI, that is Securities and Exchange Board of India. Under the capital market, there is debt market, there is equity market. In the equity market, you can buy and sell the shares. You can buy the shares, you can sell the shares. In the debt market, that is related to the debt instruments, the bonds, the debentures and such. Okay? So in the debt market, that is in the market where we are buying and selling the debt instruments such as the bonds. One important risk is credit risk. Credit risk means that the risk that a borrower may fail to repay the interest or principal on time. Let's say you are X person, okay, you are Kavya, who has purchased this debt instrument, this bond, okay, from the XYZ company, and you have invested, let's say, 1 crore rupees. Now you are afraid that what if this XYZ company defaults? What if the XYZ company do not return back this principal payment, or what if the XYZ company is not able to pay the interest for this bond, that is for 10 years? What if the XYZ company is not able to pay the interest for 2 to 3 years? So for these years you will be having the losses. So credit risk is the risk that what if the principal amount gets defaulted, what if the XYZ company defaults in the principal amount, or what if the XYZ company defaults in its interest obligation. That is also a concern. Okay, so this is the credit risk. I hope first of all credit risk is clear. So credit risk means the risk that a borrower may fail to repay the interest or principal on time. Now credit derivatives, see what are derivatives first of all. I hope you know the derivatives. The derivatives, they derive their value from some underlying asset. So derivatives, let's say they are the instruments or they are the contracts which are deriving their value from some underlying asset. It can be shares, it can be some commodity, it can be some interest rate. Okay, so let's say that I have signed a contract that after 3 months I want to buy the Reliance shares at the price of 1 share equal to 1000 rupees. Okay, and I want to buy 100 shares or 1000 shares. So what is this? This is a derivative. This is a future derivative. Okay, this is a futures contract, or this is a forward contract. That is, it is a derivative contract that is deriving its value. The value is derived from the shares. The value is derived from the shares. So see, derivative is nothing else. It is a contract. It is a financial instrument that is deriving its value from some underlying asset. Now, in case of credit derivative, think about it. In case of credit derivative, what is the underlying asset? What is the underlying asset from which the value is derived? The underlying asset or the underlying value is basically the credit risk. How is it so? Let's understand this. Let's say I am Kavya that is taking a loan, or let's say I'm Kavya that is investing in the, let's say I'm Kavya, I'm Kritika. I am investing in this debt instrument. I am investing in this debt instrument of XYZ person, of XYZ company, sorry, of XYZ corporate. Okay. So I'm Kavya, I'm a simple investor. I'm Kritika, I'm a simple investor, or Kavya or Ayush, I'm a simple investor who is investing in the debt instrument of this XYZ company. So I've invested, let's say 1 crore. Now I am afraid that what if my the XYZ company defaults? What if the XYZ company do not return the amount, or what if the company do not give the interest payments, okay, on time? So or defaults on the interest obligation. So basically I'm afraid, so I will go and I will purchase this credit default swap or credit derivative. Okay, I am buying this credit derivative. Under the credit derivative, let's say there is a contract that has been signed between Kritika and AB person or AB entity. Now AB entity is saying that Kritika will be protected. Her 1 crore rupees will be protected. Even if the XYZ company defaults, doesn't matter. The ABC entity will be responsible to pay to Kritika the 1 crore rupees or whatever the default amount is. Let's say XYZ company has given 60 lakh rupees. But the XYZ company is not able to give the rest of the 40 lakhs. So 60 lakhs have been returned to Kritika, but 40 lakh is default amount. So whatever is the default amount, that will be paid by the AB entity. Now Kritika, for this protection, is giving the premiums, the regular premiums to the AB entity. So this is the credit derivative. Credit derivative is nothing rocket science. It is just the protection that I am getting for my investment. The protection that I am getting to hedge the risk, to reduce the risk of default. Okay, so the protection I am getting, and here I am getting the protection from AB entity, and the AB entity in return is getting the premiums. Like the AB entity is basically providing insurance. We take the health insurance. What if I fall sick? What if I have to be hospitalized? So I have taken the health insurance. I'm giving the regular premiums, and the company is providing me the health protection, or the company is providing me some health coverage. Okay, so this is the idea. So Kritika has taken the protection in this case to hedge, to reduce the risk of default. Here AB entity is like, we are coming into the credit default swap. That is a derivative that in the future, if the default happens, whatever is the amount of the default, that has to be paid by the AB entity. So what is the underlying asset? The credit risk is the underlying value. The credit risk, whatever is the risk, whatever is the default, that is telling the value of the derivative, that is telling the value of the derivative. So what is the value of the derivative? What is the value of the contract? The contract is deriving its value from the default value. Whatever will be the default value, that will be the value of the contract. That is the basic idea. So I hope this is very much clear. Okay, credit derivatives, they help the market participants manage this credit risk. Credit derivative means a derivative contract whose value is derived from the credit risk of an underlying debt instrument. So whatever the default happens, according to that there will be the credit risk, and according to that there will be the value of the derivative contract, that is the credit derivative. Now one important thing here to mention is that the credit derivative, see, till now what was happening, that you can take, let's say you have invested in the stocks of, or let's say you have invested in the debt instrument of XYZ company. This is a single company, and you are taking the protection. So Kritika has invested in the XYZ company and I am taking the protection. Through the credit default swap, I'm taking the protection from AB company by paying premium. Now let's say I'm investing in the, different banks. I'm investing in the State Bank of India, PNB, or let's say I'm investing in the debt instrument of the State Bank of India, PNB, XYZ Bank, ABC Bank, KY Bank. Okay? What if one or two bank default and they are not able to pay back their obligations? What if they are not able to? What if they default? What if a small bank collapses? So I will not get my money. So basically, to get the protection, now I will have to take the protection against each and every exposure individually. So rather than that, I can take the index credit derivative. That is the credit derivative that is providing me the protection for the index of the debt instruments from multiple debt instruments through a single contract. So rather than taking, let's say I'm taking the exposure in the IT companies. Let's say I am providing the investment in the debt instrument of the IT companies, and there are multiple 1, 2, 3, 4, 5, 6 IT companies. Now instead of taking the individual protection, I'm taking the index credit derivative that will provide me the protection against all these exposures. So I hope this is very much clear. Okay? So this is the idea that I can take the credit derivative for an individual debt instrument, or I can take the credit derivative for an index of underlying debt instrument, so that my exposure can be covered or I can be protected to an extent. Okay? So I can take the credit derivative, that means a derivative contract whose value is derived from the credit risk of an underlying debt instrument or from an index of underlying debt instruments. So this is the credit derivative. Okay? They can also improve liquidity and efficiency in the corporate bond market, support the issuance of the corporate bonds, because I'm getting the protection. So I have the security, and that's why I'm investing more in the debt instruments. I'm investing more in the debt market. An announcement was made in the Union Budget speech delivered on February 1st, 2026, that total return swaps on corporate bonds, this has to be introduced. We will discuss that what are these total return swaps on the corporate bonds, and the derivatives on corporate bond indices will be introduced. That's why I said that this is something new, that till now individually I was getting the protection for my debt exposure, debt instrument exposure, but now I can have the protection in one go through the index credit derivative. I can have the protection against all my debt instruments in a particular category. Okay? So this is the idea. Derivatives on corporate bond indices will be introduced. Let's discuss this. So in the Union Budget, this was announced that the total return swap on corporate bonds and the derivative on corporate bond indices will be introduced. First of all, see, credit derivative, it is of two types, credit default swap, and now the total return swap has also been introduced. So credit default swap, this is for a long period of time that the credit default swaps have been popular in the market. Okay, so that the credit derivative system is not new, just the total return swap has been introduced, as well as the index credit derivative has been introduced. Okay, but credit default swap, they were available before also. Now what is this credit default swap? Very basic, very overall idea that we have got. This is regarding that only. Okay? Yes, correct. We will be discussing in English because many of the students, they do not understand Hindi. ठीक है? तो अगर आपको कुछ समझ नहीं आ रहा है, kindly just inform me कि क्या समझ नहीं आ रहा है. Whatever you are not able to understand, that I will explain. चलो. But just tell me that what you are not able to understand, because other comments doesn't make sense. Chalo. What is credit default swap? See, let's say there is a protection buyer, and there is the protection seller. So protection buyer is me, Kritika. I have invested in a debt instrument and I'm afraid that what if the default happens? What if the default happens? Okay. Now I'm afraid that what if the default happens? So let's say I'm taking the protection. Protection seller is the AB company, AB entity. So I will be paying some premium amount, some regular amount, and the AB entity will provide me the protection against the default in the debt instrument. That's it. So protection buyer, they are the buyer of protection. Protection seller, they are the seller of the protection. So I am doing the periodic payments to the protection seller. I am doing the periodic payments. The premiums I'm giving, I am doing the periodic payments, and in return I am getting the protection in case of credit event. That means in case of default, the protection seller will have to protect me, will have to provide money against the default. Okay, so payment has to be done. So protection seller will be giving the payment in case of the default, in case of the credit event. That is the idea. Okay, so very easy to understand, nothing much. If there is any confusion anyone has, kindly ask me. A credit derivative contract in which one counterparty, that is the protection seller, commits to pay to the other counterparty in case of a credit event, in case of default, with respect to a reference entity, and in return the protection buyer makes periodic payment. So protection buyer is giving periodic payment. In return the protection buyer is getting what? Protection against the credit event, protection against the default. That's it. That is the basic idea. Now CDS acts like an insurance against the default of the reference entity, that is the entity for which the debt instrument has been taken. Okay. Now total return swap. Now total return swap, here try to understand this. Let's say I have taken a debt instrument. Okay, I have invested in the debt instrument. So Kritika, I have invested in the debt instrument of XYZ company. Now I'm afraid that what if I do not get returns? Like this is the debt instrument for 10 years. Now I am afraid that what if in some of the years the company defaults? That means the company is not able to give the interest payment. What if the company is not able to give the interest payment on the regular basis? Now I am depending. Let's say I have invested 1 crore in the debt instrument, and I know that per year I will be getting 10%, that is 10 lakh rupees, and this is the money that I require for the operations that I am running, or for my household facilities, for my household expenditure. I need this money every year. So 10% per annum is the interest that I need to get, or I will be getting on this debt instrument. But I'm afraid that what if the XYZ company do not give this interest on in some years? So let's say I'm getting some protection, that is under the total return swap, that protects the returns to some extent. So I have done a contract with the AB entity. Now all the returns from this debt instrument will be the returns of the AB entity. So basically I'm saying that I'm afraid I have taken this exposure, I have invested in this debt instrument, but and the debt instrument 10%, I have invested 1 crore per annum, I should be getting 10%, that is 10 lakh rupees that I require on the yearly basis. But now I am afraid that what if the XYZ company for which I have taken the debt instrument, what if it defaults and do not give me this 10% per annum? What if the interest do not come on the regular basis? So I am taking the protection from the AB entity. I am signing the total return swap. Under the total return swap, basically I am saying that whatever are the returns from the debt instrument, that will be shared with the AB entity, or that will be provided to the AB entity, as well as whatever will be the losses that will go to the AB entity. So here the returns are going to the AB entity. AB entity in return will provide some fixed returns to me. Okay, some fixed returns. Let's say it is 8% or 9.5%. So whatever are the fixed returns. So I am trusting the AB entity, and basically it is providing me the protection. So even if the losses are happening, even if the interest is not coming from the XYZ company, that is the responsibility of AB entity now. So basically under the total return swap, what happens that the exposure entity that has taken the exposure, bondholder, basically is selling the returns, whatever returns are coming from the debt instrument, that I am selling to the AB entity. Every year the AB entity will get the returns. If losses happen, that also is the responsibility of the AB entity. Basically the bond, from the bond, whatever are the returns, whatever are the capital gains, whatever are the losses, whatever happens to the debt instrument, whatever appreciation or depreciation happens, that is the responsibility of AB entity. AB entity will provide me some fixed returns in return. It can be 8%, 9% according to the AB entity. So basically total return payer. So total return payer is basically transferring the entire economic performance, whatever appreciation, depreciation happens in the value of the bond, whatever returns are there, whatever losses, whatever happens to the bond. So that is transferred to the total return receiver of the returns. So transfer of returns, the total return payer is transferring the returns to the receiver of returns. In return, the receiver of returns receives, in turn, the receiver of returns, that is the total return receiver, gives, like it is providing some protection also, so or it is providing some returns in return. So the total return payer receives predetermined fixed or floating rate linked to a benchmark. So basically I was afraid that what if I do not get the interest in some years. So I have shared all the profits, all the appreciation, all the returns from the bond I have shared with the total return receiver. In turn I am getting some predetermined fixed or floating rate. Okay, so this is the total return swap. Any confusion? You can say so. In the NBFC factoring, the bills are linked. Here bonds are there. Yes, you can say so. Total return swap, a credit derivative contract. This is a credit derivative contract. It comes under credit derivatives, under which one counterparty is the total return payer. That means it is paying all the returns from its bond to the total return receiver. So it commits to transfer the entire economic performance of a reference asset, that is a bond, to the other counterparty. In return, what this total return payer is getting, it is getting some predetermined fixed or floating rate linked to a benchmark. So it is sure that every year it will be getting 8%. The default or obligation, the default of obligation is no chance. There is no default that will happen. Every year I will get 8%. So I should not be afraid. I will not be afraid. So if default happens in the returns, in the interest, if default happens, that is the headache of the total return receiver. Okay. So this is the total return swap. I hope this is easily understandable, that I am selling. Basically, I'm whatever returns, whatever economic returns I will be getting, whatever losses will be related to the bond, that will be the responsibility of the AB entity. It will get the higher returns, but it will also be responsible to tackle the losses. In return, I will be getting some fixed predetermined or floating predetermined interest or return. Now, moving forward with the last concept that we have to understand, then we will discuss the points. Okay, TRS is like swapping total returns of an asset for a fixed or floating rate. Now, suppose a banking, as I've told you that let's say I've invested in these 5 banks. So rather than taking the credit default swap individually for all these banks, that what if a bank defaults? What if a bank defaults in its debt obligation? So I'm afraid that what if the bank, or let's say there are 5 IT companies, in which I have taken the exposure, of which I have taken the debt instruments. So instead of taking the individual credit default swap, there is the credit default swap for index. For the index, okay, index credit default swap is there. So I do not have to take the individual protection, rather I would be taking the protection for the investment that I have done in the index. That is the idea. So an investor buys an index credit default swap rather than buying the individual credit default swap. Rather than buying 5 individual credit default swap or 10 individual credit default swap, I will buy a index credit default swap on the banking credit index or on the IT credit index, okay, with the notional amount of whatever investment I have done, and pays an annual premium. So if I'm taking the protection, I will have to give some premium, some regular payments, right? So that is the idea. Chalo, now coming to the what's new category. So what's new? What has changed? So accordingly, see the RBI, because the RBI has introduced the total return swap, as well as the RBI has introduced the index credit derivative. So accordingly, a regulatory framework to enable the introduction of derivatives on credit indices and total return swap. So basically 2 new things have happened. RBI has introduced the total return swap that was not available till now, as well as RBI has introduced the derivatives on the credit indices, that is the multiple companies that belong to a sector or a segment. So this is the idea. Okay, these directions shall apply to credit derivative transactions undertaken in over the counter markets. Now credit derivative transactions are undertaken. Let's say Kritika, that is me, I am through a electronic trading platform or through some other platform, I'm purchasing the debt instrument of the ABC company, of the XYZ company. Okay, so that is, I am purchasing the debt instrument outside the exchanges. Here the NSE, BSE, National Stock Exchange, Bombay Stock Exchange are not involved. So over the counter markets, over the counter means contracts negotiated privately or through the electronic trading platform between two parties instead of being traded on a stock exchange. So I have purchased this debt instrument that was not on the stock exchange, or I have purchased this debt instrument outside of the stock exchange. So whenever I am doing any transaction out of the stock exchange, that is the over the counter transaction that is happening. So I might be purchasing this derivative, credit derivative transaction. So I have taken the debt instrument outside the stock exchanges. I might be taking the credit derivative also outside the stock exchanges. Okay. Similarly, let's say I have taken the debt instrument. I've taken the debt instrument. I've purchased the debt instrument. I've invested in the debt instrument in the exchange, in the exchanges, under the exchanges, but I'm taking the credit derivative. That is, I'm taking the protection outside the exchange, outside the exchanges, outside the purview, outside the exchanges. Okay, that is, I'm privately or through the electronic trading platform, I'm taking this protection. So over the counter markets are the markets where the credit derivative transactions happen outside the stock exchange, or the credit derivative transaction if it is happening on the recognized stock exchange. So that is the second category. So this is the basic idea, that according to the regulatory framework, these directions shall apply to credit derivative transactions. Credit derivative transactions that are taken over the counter or that is on the recognized stock exchange. Doesn't matter where the transaction is happening, outside the stock exchange or inside the stock exchange, the directions will be applied to all the credit derivative transactions. Now, two important credit derivative contracts discussed here are credit default swap and the total return swap. Credit default swap, total return swap, it can be taken individually or for the index also. Eligible participants are the residents of India, the normal residents of India, and the person resident outside India to the extent specified in these directions. Yes. So eligible participants are the residents like you and me, or the person resident outside India. Now, directions on credit derivatives in the OTC market. So first, let's discuss for the OTC market. Market makers and users. Market makers are basically in any category. In the stock exchange, in any category, if you hear market maker, they are the ones that are allowed. They are the entities that are allowed to buy and sell the credit derivative. So market makers, usually we hear about the primary dealers, the market makers, they are allowed to buy and sell. Okay, they are allowed to buy and sell. So market makers are nothing else. They are the entities that are allowed to buy and sell the credit derivative. Users, they are allowed to buy only. Users, they are allowed to buy only. Okay. So market makers, they are allowed to buy and sell the credit derivative, while the users, they are allowed to buy the credit derivative, that is, buy the protection. So the market makers, they can buy the protection, they can sell the protection. Users, they can only buy the protection. So market makers and users can undertake transactions in the credit default swap and the total return on swap contracts subject to the conditions. Market maker is an entity that is allowed to offer credit derivative contracts. They can buy as well as they can sell the protection. They can buy or sell the credit derivative. User is an entity that uses the credit derivative contract either for hedging purposes or for other permitted purposes. For the speculative purposes also maybe. The user is an entity that use the credit derivative contract that buys the protection. Basically, okay. Who can act as market maker? Now, which are the entities that can act as the market maker? They are allowed to buy and sell the credit derivative. So the following entities are the entities that are eligible to act as market makers. Scheduled commercial banks except small finance bank, payment bank, local area bank, and the regional rural bank. Standalone primary dealers, the NBFCs, the upper layer, and the NBFCs in the middle layer. We have discussed that NBFCs are in base layer, middle layer, upper layer, top layer. So the higher you go, the larger the NBFC is. So NBFC in the upper layer and NBFC in the middle layer, including the housing financial companies, they are allowed to be the market makers. They are allowed to buy and sell the protection. Export Import Bank of India, that is Exim Bank, the NABARD, NHB, SIDB, NAFID, they are also allowed. So that is the All India Financial Institutions, they are also allowed to buy and sell the credit derivative. So who can act as the market maker? Scheduled commercial bank, excluding the small finance bank, payment bank, local area bank, regional rural bank, the standalone primary dealers, and these entities, they are allowed to become the market makers. Important condition is that at least one of the parties, see, in the credit derivative, at least one of the parties should be market maker. That means if one party is user, that is the buyer of the protection, the other party should be the market maker that is able to sell the protection, or the market maker can also buy the protection, so the party is the market maker that is selling the protection. So at least one party should be the market maker. Both the parties can also be market maker, but at least one of the parties to a credit derivative transaction shall be a market maker or a central counterparty. If the market maker is not able to sell the protection, then user can buy the protection from the central counterparty, okay, authorized by the RBI for this purpose. Now, user classification framework. So basically, important condition we have discussed, at least one of the parties should be the market maker or central counterparty authorized by the RBI for the purpose. User classification framework, users shall be classified by market makers, either retail or non-retail. So users like you and me, individuals usually cannot directly enter in this credit derivative contract, but users shall be classified by market makers either as retail or non-retail for the purpose of offering credit derivative contracts. So the following users shall be eligible to be classified as non-retail users. So who are the non-retail users? NBFCs other than market makers. So NBFCs in the base layer, or NBFCs that are not able to be the market makers. So NBFCs other than market makers, they are the non-retail users, or they can be non-retail users. Insurance companies regulated by Insurance Regulatory and Development Authority of India, that is IRDI. Pension funds regulated by PFRDA. Mutual funds regulated by SEBI. Alternative investment funds regulated by SEBI. Resident companies with minimum net worth of 500 crore and above. So minimum net worth of 500 crore and above, or minimum turnover of 1000 crore and above. So these can also be the non-retail users. Foreign portfolio investors registered with SEBI, so FPIs registered with SEBI, and any entity otherwise eligible to be a market maker. So these are the non-resident, these can be the non-retail users. Okay, so that is NBFC other than market maker, insurance companies, alternative investment fund, pension fund, mutual fund, resident companies with minimum net worth of 500 crores and minimum turnover of 1000 crores, or minimum turnover of 1000 crore, FPIs. So these are the non-retail users. Other than these, all will be the retail users. Okay, so these are the non-retail users. Other than these, all will be the retail users. Now, participants in the credit derivatives in the over-the-counter market. Over-the-counter market, see, this is the more risky market because here the exchanges are not involved. If the exchanges are not involved, that means this is a risky segment where the contract is being signed, but there is no party that is looking after the contract, or cheating might happen. Okay? Because the exchanges and the strict rules and the strict intermediaries of the exchanges are not involved usually. So over the counter market, so participants in the credit derivatives in the over the counter market. So prediction buyers and sellers for credit default swap. First, let's understand the credit default swap in the over the counter market. So a resident retail user other than an individual. So individual is not allowed in the over the counter market for the credit default swap. That is the basic understanding, that because the over the counter market for the credit default swap is more riskier as the exchanges are not involved. A resident retail user other than an individual shall be allowed to buy CDS protection only for the purpose of hedging. So a resident retail user, they can buy the CDS, credit default swap protection, only for reducing their risk. Non-retail user, that we have discussed, the alternative investment fund, mutual fund, FPIs, so insurance companies, pension funds. So non-retail users shall be allowed to buy the protection for whatever reason they want to buy the protection. That is the idea. Now, following non-retail users shall be eligible to act as protection sellers, that is basically the market makers in the OTC market for the credit default swap. ठीक है, इंश्योरेंस कंपनी, पेंशन फंड, म्यूचुअल फंड, ऑल्टरनेटिव इन्वेस्टमेंट फंड एंड एफपीआई रजिस्टर्ड विद सेबी. So this is the idea. ठीक है, so these are the market makers that can act as the market makers in the credit derivatives in the OTC market as well as in the exchanges. But when it comes to the OTC market, when it comes to the credit default swap, there are additional, like these are also provided. So the following non-retail users shall be eligible to act as protection sellers. Protection sellers. So insurance company, pension fund, mutual fund, alternative investment fund, FPI registered with SEBI. This is only for the credit default swap. Now FPIs are allowed. See, we have discussed this previously also, like if you have seen those video. So basically the credit default swap, see FPIs, they can sell. FPIs, the foreign portfolio investors, they can sell the credit default swap. But there is a limit. How much credit default swap can the FPI provide? So FPIs are allowed to participate in the credit default swap contracts, but RBI has placed specific safeguards. The total notional amount of credit default swap protection, so total value of the credit default swap protection sold by all FPI shall be subject to a limit of 5%